I have been intimately involved in the mechanics of global finance and, more specifically, the opaque world of precious metals for longer than most participants have been alive. I have seen orchestrated takedowns, controlled demolitions, and frantic parabolic blow-offs. But what transpired in the silver market during that period, culminating in a flash crash that few saw coming, transcended mere volatility. It felt less like a market correction based on fundamentals, and more like a desperate surgical attempt by entrenched interests to maintain control over a narrative that was already escaping their grasp. This was not your typical run-of-the-mill, low-volume Friday afternoon sweep designed to harvest stops. This was a sudden, devastating price dislocation executed with such overwhelming paper force that it momentarily paralyzed algorithmic trading systems and vaporized billions in nominal value in the span of hours. It was a liquidity vacuum that sucked the price down into a region that fundamentally defied every supply-demand metric on the planet. I want you to internalize this detail. Every proprietary desk I spoke to, the ones who pride themselves on anticipating these maneuvers, was caught completely flat-footed. They were utterly unprepared for the sheer velocity of the move. But the real story, the part that validates the decades-long skepticism of market legends like Eric Sprott, lies in the immediate aftermath and the ensuing divergence between the electronic price and the physical reality. While the computer screens showed panic, indicating a massive surplus or a complete collapse in demand, the physical market did the exact opposite. The moment the paper price broke, phone lines at major mints and dealers melted down. Vaults that had already been experiencing historic drains saw demand accelerate into a frenzy. Sprott's thesis, the one he has championed since the earliest whispers of genuine shortages, was violently confirmed. The tail of the paper market was attempting to wag the dog of physical reality, but the dog was finally biting back. To truly appreciate the significance of this event, we must contextualize the market setup leading into the crash. For years, silver has been the neglected stepchild of gold, priced primarily as a monetary hedge, while its crucial role as an industrial commodity was systematically undervalued by derivative markets. But that changed rapidly over the last few cycles. We have entered a structural deficit driven by forces far larger than investor sentiment. The proliferation of photovoltaic technologies, solar panels, is consuming enormous quantities of silver. Furthermore, the global push toward electrification, from electric vehicles to complex consumer electronics, is demanding higher and higher amounts of the metal due to its unparalleled conductivity. The data is incontrovertible. We are facing historic supply deficits. The Silver Institute confirms that global demand is outstripping mining supply by staggering margins, yet the paper price, managed primarily through the vast and complicated leveraged structure of the COMEX futures market, stubbornly resisted a true breakout. This inherent conflict is the central friction point in the entire saga. The problem, as Sprott has meticulously documented, lies entirely within this COMEX structure. For every single ounce of physical silver held in registered exchange vaults, the metal actually available for delivery, there are literally hundreds of ounces. Some estimates put it near 500 to 1, trading in the form of futures contracts, unallocated accounts, and various other paper instruments. This gargantuan leverage is what creates the illusion of liquidity and supply. When institutional players, sensing the inevitable retail-driven squeeze and the rapidly dwindling registered inventories, decide to execute a massive liquidation, they don't sell physical metal, they dump paper futures contracts. This flash crash began not because of a negative macro event, but because this deep structural disconnect between paper and physical reached a breaking point. We saw a calculated, massive short-side intervention designed to exploit the very mechanism of margin calls. It was a rapid fire sale of contracts into thin market depth, creating a cascade effect that forced even previously solvent, leveraged long positions to liquidate immediately. The immediate questions that arose, and these remain open loops that fuel speculation, are critical. Was this purely a defensive maneuver by the major bullion banks to defend specific short positions they were losing control over? Or was this the result of a margin call cascade so large, triggered by a failing major prime broker, that it threatened system stability, necessitating a quick, deep price reset to stabilize collateral requirements? And critically, how did Eric Sprott, the man who built his empire on the precise bet that this system would eventually fail, react to this extreme volatility? Sprott's entire investment philosophy rests on the conviction that market prices must eventually revert to the true cost of production plus a sustainable margin driven by fundamental scarcity. He has long argued that decades of suppressing silver prices via derivatives have decimated global exploration budgets. Silver is primarily mined as a byproduct of other metals, like zinc, copper, or lead. Primary silver miners, those focused solely on silver, are scarce. The consequence of low prices is chronic underinvestment. We are now paying the piper for that suppression. To meet the accelerating industrial demand, we require massive, sustained capital expenditure, yet the recent volatility makes mining stocks appear deeply uninvestable once again, which is the precise pattern interrupt that ensures even greater future shortages. I distinctly recall his commentary emphasizing that even a price of $30 per ounce, while certainly profitable for some shallow mines, was wholly insufficient to incentivize the exploration and development of the kind of deep, large-scale primary silver mines required to close the structural deficit globally. The flash crash, by briefly pushing the price below crucial psychological levels, only intensified this dilemma, making the long-term supply picture even darker. This whole phenomenon is why we now universally refer to this acceleration as the silver fever. It is no longer just a nuanced portfolio allocation strategy. It is an undeniable existential necessity for industrial economies globally. The retail investor base, often late to the party, is finally waking up to the fact that silver is not just poor man's gold. It is the essential metal of the modern economy. This flash crash, far from being a sign of weakness in the rally, was the most violent confirmation possible that the underlying physical foundation is extraordinarily sound. But the market structure used to trade it electronically is fundamentally fraudulent and broken. Sprott was unequivocal. This was the paper market's final desperate attempt to push back against the inevitable physical reality. The great defining revelation of the event, confirmed through the highly secretive channels of major sovereign and private mints, was the speed and scale of the physical absorption. While the electronic charts showed prices free-falling, signaling panic selling, the physical premium, the amount you had to pay above the spot price for actual bars and coins, soared to historic highs. Sprott wasn't just holding, he was engaging in a massive, aggressive accumulation phase. His public-facing investment vehicles reported unprecedented inflows, confirming that the smart money viewed the collapse as the sale of the century. It wasn't a panic, it was a raid executed by those who understood the disparity. We are now operating with two entirely separate silver markets, the broken leveraged electronic market and the functional, impossibly tight physical market. This disparity is the ultimate proof that the paper price is rapidly becoming meaningless in the face of genuine systemic demand. What we witnessed was the paper system buckling, groaning, and momentarily failing under extreme pressure. Eric Sprott understood instantly that this violent volatility was not a warning to flee the metal, but a loud, piercing siren announcing that the final breakout, the true reckoning for silver, is now imminent. The fever is here, and the unexpected flash crash was merely the fever violently breaking the thermometer. But comprehending why this cataclysmic event occurred is only the critical first half of the equation. In part 2, we must pivot our focus entirely to strategy and dissect Sprott's exact tactical response post-crash, the specific mining equities, the investment vehicles, and the precise mathematical pathways he is utilizing to capitalize on this volatility, and most importantly, the detailed economic modeling that leads him to forecast a true triple-digit valuation for silver in this cycle. Stick with me as we unpack the crucial next steps in the great silver accumulation phase. I want to bring you back to that moment, that sharp, shocking plunge that defined the volatility we are currently experiencing. We call it the flash crash, but what was it really? It wasn't a sudden, reasoned decision by the collective market that silver was worth less. It was a digital assassination attempt, a calculated maneuver executed with lightning speed, designed purely to liquidate weak hands and destroy confidence. I watched billions of dollars vanish on screens only to reappear minutes later, an ephemeral illusion that only solidifies one terrifying, glorious truth. The people who control the paper market are genuinely panicking because they are losing control of the physical market. That crash was not a sign of weakness in silver. It was the final, desperate lurch of a dying beast. This is the second hook, and I want you to anchor this thought firmly. The system that dictates the price is fundamentally disconnected from the supply that services the world. The context is crucial. When those algorithms dumped millions of ounces of paper futures, they didn't flood the physical supply chain. The refineries weren't suddenly overflowing. The buyers in India and China didn't hang up their phones. In fact, they did the opposite. While the Western retail investor panicked and saw red, the major global buyers saw an unimaginable gift, the chance to acquire physical metal at a price that, structurally, should no longer exist. They became the immediate beneficiaries, draining the accessible inventories at fire sale prices, accelerating the inevitable inventory crisis. The problem, the core conflict, is the psychological warfare being waged. They need you to believe that the paper price is real, that liquidity is abundant, and that the risk of holding physical metal is high because volatility will crush you. But I ask you, what is the risk of holding a commodity that is demonstrably being consumed faster than it is being mined, regardless of the momentary blips on a futures screen? The conflict is simple: fear versus reality. The flash crash was the ultimate stress test. It successfully terrified millions, causing them to sell near the bottom, proving that the paper system still holds sway over the fragile human psyche. But for those of us focused on the metallurgy, the supply chains, and the vaults, it proved something else entirely, that the price manipulation mechanism is exhausting its ammunition. This leads us directly to the open loops that keep me awake at night, the ones that guarantee the next stage of this silver fever. Forget the dollar price for a moment. Focus entirely on the inventory levels at the COMEX, and more importantly, the speed at which the eligible silver is being reclassified and shipped out. The vaults are being systematically emptied. We are witnessing an unprecedented, non-stop physical drain. And why is this happening now? Because the industrial demand, the demand that cannot be turned off by margin calls or bearish punditry, is soaring. Let's delve into this development with the necessary detail. We are not just talking about trinkets and coins anymore. We are talking about the foundation of the global energy transition. Think about solar photovoltaics. Every new solar panel mandated by governmental net zero targets globally requires silver paste. This is non-recoverable consumption over the lifespan of the panel. The push toward massive solar farms is accelerating exponentially, and each gigawatt added requires staggering amounts of this precious metal. But it doesn't stop there. Consider the electrification of transportation, the electric vehicle revolution. EVs require significantly more silver per unit than traditional internal combustion engines. This is due to the complex wiring harnesses, battery management systems, and numerous high-reliability switching mechanisms that operate under high current. This is not a marginal increase. This is a geometric leap in demand for a metal whose supply is constrained by geology and decaying primary mine production. Silver is usually a byproduct, and you cannot simply ramp up silver production without ramping up copper, lead, or zinc production, which is a multi-year, multi-billion-dollar endeavor. This is where the pattern interrupt comes in. Most analysts look at the price and project demand. We, however, must look at the mandated policies and project the absolute necessary minimum demand, and then compare that to the known, available supply. When I try to procure large physical quantities of silver, and I mean institutional, serious tonnage, the reality hits hard. The market is tight. The premiums are rising. The lead times are extending. This is happening even when the paper price is temporarily suppressed by a flash crash. This disconnect is unsustainable. The paper market can produce billions of theoretical ounces in minutes, but it cannot produce a single physical gram to fulfill industrial contracts. Now, let me re-engage you with the original premise. Silver fever is here. That momentary, terrifying drop was the market giving you a final chance to assess your conviction. Was your position predicated on flimsy rumor or on the hard, immutable laws of supply and demand? If you held through that volatility, you are fundamentally ready for the climax because you have internalized the critical understanding. The game has changed. The climax is approaching, and it is not going to be a gentle glide higher. It will be a violent repricing event. The closure of these loops is inevitable. As industrial consumers realize they cannot fulfill their massive multi-year contracts, think billions of dollars worth of solar panels or EV batteries, without the necessary physical silver, they will pivot from price sensitivity to absolute necessity. They will stop negotiating for $25 silver and start bidding whatever is necessary to keep their assembly lines running. They will bid $50, $75, and then $100 per ounce, because the cost of a halted factory line far exceeds the cost of a slightly more expensive component. This is the great revelation that the flash crash temporarily masked. The suppression mechanism is exhausted and the industrial clock is ticking down to zero. The COMEX must eventually default on its physical obligations or allow the price to rise to a level that either kills industrial demand, highly unlikely given global mandates, or incentivizes massive new mining production, impossible in the short term. Since neither demand nor supply can be readily adjusted, the price must become the equilibrator, and given the massive structural deficit, that equilibrium price is exponentially higher than where we are today. The flash crash was the final clearance sale before the inventory shelves become completely bare, triggering a run on the bank that no amount of digital printing can satisfy. The conclusion is definitive and urgent. We are past the point of return. The narrative that silver is merely a relic of the past has been permanently shattered by the mandates of the future. The physical market is screaming scarcity, and eventually, the paper market will be forced to listen, not through gentle adjustment, but through catastrophic failure and violent repricing. This is not a temporary bull run based on inflation fears alone. This is a structural shift driven by technology and geopolitics. The fever is real, it is intensifying, and the only remaining question is not if silver will reach triple digits, but how fast the collapse of the paper system will force it there. So, what is the specific call to action? Ignore the noise. Ignore the manipulative plunges. Every flash crash is simply a gift from the dying suppressors. Your job now is maintenance. Hold your physical ounces and the high-quality mining equities that possess real metal in the ground. Position yourself for the scarcity premium. Do not trade this. Own it. Because when the price finally breaks free, when the physical reality overwhelms the paper illusion, the velocity of the move will be so extreme that those caught on the sidelines will have zero chance of participating. We are standing on the precipice of the greatest commodity squeeze of our lifetimes. Be positioned, be patient, and prepare for the payoff.